Today we're going to talk about the ABCs of residential real estate loans. There's several areas we're going to touch base with today. Here you go. The first step in the process is always pre-qualification. So what does pre-qualification mean? That means that what we're going to do is determine what you can and can't qualify for as far as the size of the loan, the monthly payment, what you're comfortable with, etc. The four main areas of qualifying are income, credit, assets, and size of your down payment in regards to a purchase versus equity. Let's say we get a call today from somebody looking to buy their first home. So we're going to ask them a series of questions. First, we're going to find out where the property is located. Then we're going to find out what type of property we're dealing with. Is it a house? Is it a condo? Is it multi-units? Is it a commercial building? And then we're going to find out what's the purpose of the loan. Is it business purpose or consumer purpose? Business purpose means for investment purposes versus consumer purpose, which would be to buy a house to live in or to refinance your house to pull out cash to remodel it. I'll have Karen now talk a little bit about the four areas of qualifying and how they differ on institutional versus private money loans.
So for institutional loans, it's much more difficult, like Ken mentioned, to get an institutional loan. The banks look at income, they look at credit, they look at your assets, and then they look at the equity in the home, either how much equity you have in the home if you're doing a refinance or what the down payment amount will be. When you look at the income with an institutional loan, they'll look at your pay stubs, your W-2s, your tax returns. They'll scrutinize those because they're trying to qualify you to make sure that you can make those payments. Then they'll look at your assets. Do you have enough money in the bank to make your payments? Third one is credit. The institutional lenders will look at your credit history. Payments that you've made on either your mortgages, your cars, your student loans, and your credit cards. And the last one is down payment or equity in the home. So an institutional bank will look at the amount of down payment if you're going to be purchasing a home. Whether it be a primary residence, investment property, or second home, the down payment amounts may vary. Lower for a primary residence, higher for an investment or second home. That's for institutional lending. If you want a private money loan, it's much easier to qualify for. These private lenders, they base their decisions mostly on equity in the properties. As far as credit's concerned, on a private money loan, we don't base our lending decisions on credit. We may require on a private money loan to have more equity or a higher down payment on the property because, again, we are equity based. So an institutional loan, you may be able to get by with 5% down, whereas on a private money loan, it may be more like 25 to 30% down.
It's much more complicated and intensive to get an institutional loan, and rightly so, than it is a private money loan, because private money lenders depend on equity versus institutional lenders depend on the borrower.